With Pramod Gubbi as well, who joins in to give us an insight as to how he's looking at the markets. And Pramod, you continue to get news on the medical front, and things are not looking good in terms of the cases globally as well that are spiraling. And the last time we interacted, that you said that as we get more and more bad news on the coronavirus front, that could trigger further downfalls for the market. But somehow, while we have seen quite a bit of pain, there has also been that, those bursts of exuberance. What do you make of that? Is that justified in nature with things globally, etc., improving? Or do you think it's just irrational in nature?
Well, I don't think it's irrational because a lot of the rally is being driven by the sheer amount of liquidity that the Western central banks have pumped in, both in terms of monetary stimulus and the government implementing fiscal stimulus. The numbers go up north of $5 trillion. So I don't think the markets can ignore that, and that's clearly the explanation. Having said that, I think there is reason to be positive from a relatively longer-term basis. First, I think you need to assume that given the sort of efforts that's going on globally to find a vaccine and a cure, pretty much bulk of the pharma and the biotech industry is behind it. There's billions of dollars in terms of R&D expenses running behind it. You have to be positive that in the next 12 to 18 months, we'll have to at least reasonably tackle this issue, and the world will return to normalcy. And what's happening in East Asia, particularly in China, when lockdowns have been lifted, you can get a glimpse of what is likely to happen to demand and economic activity. Some of the numbers that we're receiving from China has clearly surprised us, like the Disneyland tickets selling out, or Airbnb showed up in sales, or even auto sales picking up, and so on. So our sense is, if you are willing to take a relatively longer-term view, there is reason to be positive, both from a rational economic standpoint, as well as the sort of liquidity and stimulus support that we're getting from governments and central banks globally.
Or even the Hermes store being completely raided in China. But, point taken, of course, Pramod. So in case of that, say investors are looking to stick it out through the kind of pain that we're seeing in the markets right now, let's talk about where the opportunity lies. Some sectors are seeing very lucrative valuations as well, throwaway prices. Do you reckon that it's a good time to buy, and which would be those particular spaces according to you?
I think the big call that investors need to make is, if you are indeed willing to take that relatively longer-term view, you need to make a call on which are the sort of companies which will be able to best survive this sort of crisis period. Because in the interim, there will be pain, right? I mean, it doesn't take a genius to say that we are in a recessionary environment. Just looking out my window, I can make that call. And perhaps this pain will persist for a relatively extended period of time. Even if the lockdown gets lifted on Monday, given the sort of exodus of migrant workers, there could be labor issues, given there are balance sheet issues with several firms. So I don't think the pain will go away in the short term. So therefore, it's important for investors to pick and choose companies which are best positioned to weather this storm. And you can make a call based on two or three factors. One is, you need to look at the balance sheet. Does the balance sheet have enough ammunition to survive, to be able to handle those fixed costs with not much of a revenue? And hence, the strength of the balance sheet becomes a key characteristic of a company that you will choose. Secondly, you should be in a business where the demand for your goods and services should be relatively essential, which are not completely discretionary, which consumers will postpone forever. At best, it can be postponed for a short term, or maybe they're even essential for their daily life, even during the lockdown. And the third is relative competitive advantage. It is clear that this painful period will result in consolidation across sectors. There will be stronger companies in every sector which will emerge out even more stronger with a larger market share. And whenever the recovery happens, it is a Goldilocks scenario for these companies, because there'll be the few companies which are left, and hence they gain disproportionately upon that recovery. So the whole focus should be on being able to survive this crisis, rather than trying to be very opportunistic in terms of valuations and so on. Particularly in the case of financials, which has been most beaten down. You asked about sectors. I think that's one sector where even some of the really good franchises with very strong balance sheets, very strong liability franchises are trading at really attractive valuations. And if you were to get opportunistic on a valuation basis, I think don't look beyond quality financials.
Are you not a little concerned, Pramod, after what we've seen from ICICI Bank, or for that matter, the way the market has been punishing SBI as well, on what really is going to be the prospect of financials going forward? There are corporate books of large banks like ICICI Bank which have come under pressure because 30% of the corporate book chose and opted for the moratorium, giving you a feeler of what is lined up for the next few quarters to come, because their book will have to provision higher for the NPA-related stress which is bound to come. And look at what's happening to SBI. I mean, there's no denying that it's a right buy right now, but it's even sub the March lows, grinding at a 52-week low and still sinking further.
Well, I think what I just talked about in terms of looking for characteristics that will make the company survive the crisis is even more amplified in the case of financials, simply because financials are a leveraged bet, right? So the capital is leveraged to the extent of the sort of debt to equity, and therefore they're always a high beta sector. So in the upturn, they always outperform the markets, and vice versa during the downturn. And therefore, the need to look at survival is even more exacerbating in the case of financials, which is why, rather than focusing on the asset side, I don't think any of us will be surprised that NPAs will go up. It's pretty much a given. Given the state of economic activity, even the best lenders, the best quality lenders will see an increase in NPAs. There might be a differential in to what extent NPAs rise for some banks and NBFCs versus the rest of the sector. But by and large, most of the sector will still see an increase in NPAs. However, the answer to whether these banks and NBFCs will survive this extended period of lockdown or slowdown in economic activity doesn't lie on the asset side. It's more on the liability side. So you need to look at capital adequacy, whether the equity base of the bank or NBFC in question is strong enough to survive a significant increase in NPAs. And B, you need to look at the deposit base. Is the deposit base sticky? Is it long enough duration that you don't have to face refinancing risk? Typically, any deposit base with largely retail fixed deposits, preferably longer tenure, including CASA and term deposits, always an indication of a very strong balance sheet. So if you're satisfied on the equity and the liability franchise, I think you can be, at least it's a calculated risk that the bank or NBFC in question will be able to survive this crisis. There are several banks and NBFCs which are reliant on wholesale deposits, particularly given the issue with mutual funds on the debt mutual fund side. They will be strapped of liquidity, and that can cause survival issues. But on the other hand, if you're retail focused on the liability side with a strong capital adequacy ratio, I think the chances that you will emerge out stronger on the other side are quite high, and those should be the bets that you need to make on the financial sector.
All right. Thanks so much for joining us then today, Pramod.